Hey everyone, Chris Lopez here. And before we get into today's deal, which is actually my first ever international real estate investment, I want to spend a few minutes and talk about constructing your portfolio and creating diversification. And also, does diversification make sense? Now, I'm not giving financial advice on here, but I think a lot of you know my background as a financial planner. I have a financial planning degree from Virginia Tech, so I have a financial planner mindset. But I'm not licensed. I'm not giving financial advice out here. But I always like to think about in that 20, 30, 40-year type time window, how can other real estate investors go out there and just, win at the game of real estate, right? Get the net worth, get the cash flow, get the lifestyle that we all want. Now, I think it's very hard to do in a few years, but I think there's a high probability when we look at like a 10 or 30-year type timeline. So with that said, I was reflecting on kind of my journey and just trying to create some framework around diversification versus concentration. Because I was thinking about this when I was a young, brand new investor in real estate, which is over 15 years ago now. I did not care about diversification. It was all about concentration. I need to go out there and find deals that made sense in my market and the strategy that made sense for me, plus also with my much more limited finances back then, right? And so I focused on concentration on these specific investing techniques until I built, a great portfolio. And then the market changed, my life got busier, and I had a desire to go less hands-off, and I started transitioning from active and concentration to how do I go out there and create diversification. So I think it's really interesting to think about that, and for people to go out there and determine where you are in that investing arc, but that's a pretty typical journey I see investors make, myself, and then we got all sorts of people on that spectrum on the listening to the podcast right now, the brand new people folk concentrating, and the people who've been doing it for a while, and they're hands-off and want diversification through passive investing. The last couple of years, I've been very much focused on the diversification standpoint. And really the main themes have been, how can I get, more cash on cash day, more cash for the day? How can I reduce my risk and make sure my capital has a good risk-adjusted return and hopefully not lose, money on the investment, right? A lot of people are going through pain right now. A lot of deals have gone sideways. And that's got me a lot more focused on, investing in debt the last couple of years. Now, something else I've been watching from a macroeconomic standpoint is just what's happening to the US dollar as a currency, right? Historically, it slides every year. The dollar gets weaker. And last year, I think it was one of its worst years. I forget the exact stats, but the last year or two has not been kind to the US dollar. So, from a global portfolio construction standpoint, my financial planning mindset wants to go out there and have some hedge against the US dollar. I want to have some international exposure. Now, I have a lot of international exposure through, my index funds and SP 500, like those types of investments. I don't have any specific international like ETFs nor investments, but I wanted to change it. Now, I was not focused on real estate or stocks, but just, over the last year as opportunities and networking happened, a really interesting opportunity came across our plate at Property Llama Capital, and that is a Canadian private lending debt fund. So it checks off the boxes we've been focused on, which is, income today, downside protection on losing capital, but also checks off that box for international exposure and also has a different tax structure help actually go out there and create some better after-tax returns, a lot of other debt funds. So it's just a very interesting type of investment that makes sense for some people's portfolio. Now, we are sharing this live webinar we did a few weeks ago with the founder of Leeward Capital Partners. And that's the fund I invest in, and we're also partnering with to bring investors to. I'm sharing it for two reasons. I mean, one, obviously, I want to get the word out there, and if you're interested, let us know, and we'll get you more information. But also just to keep conversation going forward as what type of diversification do you want in your portfolio? All right, well, I will wrap up here. I'll let you enjoy the webinar recording. If you have any questions or thoughts, please reach out to me. Again, welcome to our Property Llama Capital webinar, where we're presenting a new opportunity with Leeward Capital Partners, a private credit platform focused on residential mortgages in Canada. So my name is Chris Lopez. I'm your host today. I think a lot of you know me, but I graduated with a financial planning degree. I am not a licensed financial planner, so I'm not giving financial advice, but I share that because that long-term wealth building, how to diversify your portfolio, how to structure it, that's always a big thing that I look for when I invest my money and as we structure deals as well. I started becoming an active landlord 15 years ago now. And then about 7 years ago, I started investing passively. And I've done most of my passive investing through multifamily syndications and then private lending funds like the one we're talking about today. And of course, I'm the co-founder of Property Llama and the host of the Passive Pockets podcast. But the agenda we'll go through today is the quick executive summary on our new offering. And then we're going to go through and meet the Leeward team, talk about the Canadian mortgage market. We'll talk about Leeward's strategy. They also have an amazing tax efficient structure, which I think many people will be happy to see. Then we're going to talk about some currency hedging strategy, the leverage strategy they're putting in place here next few weeks to month or so, and then just go through a lot of next steps, learn more, and some open Q&A. But quick disclaimer, this webinar is for educational and informational purposes only. It is not an investment offering. That will come in the form of our subscription documents. So make sure you refer to those. And of course, always talk with your professional team to make sure you're making the right moves for you and your portfolio. All right, so the executive summary. Leeward Capital is part of our Property Llama Capital 3 fund, which is a real estate income fund. Now, Leeward specializes in first and second lien Canadian mortgages, and they are bridge loans, fix and flip loans, and short-term refinances with strong housing fundamentals and favorable private lender regulations in those Canadian markets. Now, the target 2026 returns are approximately about 12.6 to about 15.4% cash on cash. Depends on the share class. Now, two things I'll mention on here, and we'll talk a lot more about both of these. One is that there's a huge tax advantage. I think as most people know, debt funds don't give you depreciation. So we look for other ways to go out there and lower the tax burden. What Leeward Capital has done here is they have treated this as qualified dividend income. So you get taxed at a much more favorable rate, anywhere from like a 30 to 50% tax reduction, which means it could be about a 30% after tax returns increase compared to an ordinary fund where you get taxed at like an interest or ordinary income fund. Now, of course, check with your CPA, but I think it's very good to look at after tax returns as well. And you can see here that 12.5 to 15.5 range we talked about would be the tax equivalent yield on an interest income fund from about 16.8 to about 20.4%. Since this is a new fund, we have a special offer, and anyone that invests before April 30th will get bumped up to the next share class for the life of your investment, which approximately translates into about a 6 or 7% increase in your return. $100,000 minimum investment, 15-month lockup period, accredited investors only, and this is a K1. All right, I know that was a lot there, but we'll go into more details, but I'd like to give you guys the quick summary of it. So backstory on how we met Hugh, who's the founder of Leeward Capital. We got connected in November 2025, and this was actually by the same sourcing partner that introduced us to Llama Capital. As we were looking for our next debt fund with above market yields and excellent downside protection, we looked at a lot of opportunities. And as we were sifting and sorting, Leeward came out at the top on this round. And so, we always look to build deep and long-lasting partnerships with our sponsors. And it's a huge plus that Hugh actually lives in Denver, Wash Park to be exact. And since we connected with him, we started an extensive due diligence. I made a personal investment in early January, and then it's all culminated last week where we did a 3 or 4 day on-site due diligence trip and asset tour in Toronto, Canada. You can see we got some photos there of us looking. That middle one is people in the back not trying to be car sick in the back of the van while we're driving around to go look at some properties. But it was a great trip. Everything passed due diligence, and we'll talk a lot more about that. But we'll let you guys know that, we've done our DD, and we're excited to offer this opportunity. Last thing I'll say is we pride ourselves at Property Llama Capital about transparent and clear communication. Our goal is to deliver exceptional opportunities with transparent operator relationships, clear communications, and just very direct and clear due diligence as well. So that said, I'm going to switch the decks here and actually introduce Hugh Tawney, who is the co-founder, the founder of Leeward Capital. Sorry, I got my own co-founder mixed up in there.
Well, thanks, Chris, and thanks everybody for taking the time to join in and learn a little bit more. Really appreciate it. Maybe just quickly, I'll go into my background a little bit.
Yes, please.
And then introduce some members of the team that we have here, and then just kind of jump right into it. Obviously, please send over questions like Chris said, because the more interactive this is, the better it is for everybody. And I'm sure Chris will prompt me and push me as need be. But so yeah, like Chris said, Hugh Tawney, I'm originally from Baltimore, Maryland, came to school out here, moved back east, and moved back out here with my wife about 5 years ago. I've spent my entire career in financial services, with the bulk of my career being in fundraising and asset management and structuring. So I've done public market equities, fixed income. I did a stint helping build a sell-side investment bank, small sell-side investment bank with a buddy out of business school. I've done life settlements, venture growth secondaries, venture funding, and it all kind of culminated to this, which is now Leeward and Canadian mortgages of all things. But so if you look at the slide here, so you have your team here in the U.S. is myself, Stephen Iliff, who is our chief financial officer, has a big background in fund accounting. Most recently, he was with a group called IBEX, which is a local venture firm, tech venture firm that only does Israeli tech investments, because of course you go to Denver to find that.
Very specific.
Their offices are between here and Tel Aviv, but he did all the fund accounting and controlling for about 38 entities with them, including a fund, and then 38 additional entities, and has a vast background working for some major players in the space, the SS&Cs and like. So very happy to bring him on. And then Aaron Enzinger. Aaron is our COO. Aaron, again, also a vast background, but most recently he was with a family office here in Denver that you all would know. They may or may not be associated with a larger sports team here that didn't do so well last year. And then, but prior to that, he was with Aeromark, and he actually helped build Aeromark's origination platform in multifamily. I think they did like $5 billion worth of deals over his tenure there. So really happy to have him on. And then Amin is not officially part of Leeward. He's not, but he is a partner in operations. So Amin is the individual that introduced this opportunity to me. He is a Canadian real estate attorney by trade. We all have to remember that Canada is a country of about 40 million people, so it's about the size of Texas. And in Canada, attorneys wear multiple hats. So he was a named partner of a small firm where they did real estate and then trust and estate work. I met Amin in New York at a life settlements conference, because of course that's where you go to meet Canadian real estate attorneys. But at the end of the day, we became friends. I was traveling up there once a quarter for board meetings, and we hit it off. And then we launched in November of 2024. About a year and a half, maybe 2 years prior to that, Amin called me up one day and said, "Hey, what do you know about Canadian residential private lending?" I said, "Absolutely nothing." So why don't you tell me? And the gist of it, and let's maybe move forward on the slides here. The gist of it is that there's a lot of similarities between the US and Canada in lending, right? Canada is, from like a legal perspective, we're both Commonwealth law. It's US kind of 2.0. But there are a couple key differentiators. One being that there's a massive supply demand imbalance. So the capital markets in Canada currently can't support the demand for private mortgages And the demand for private mortgages is created through regulation that the Canadian government has implemented on banks. The big, there's 6 banks in Canada. And so that creates a massive inefficiency. And as we all know, that's what we want to look for in capital markets. So from that perspective, you get an additional kind of like 300 to 500 basis points of unlevered gross yield, just because the capital markets up there currently can't support, the demand that exists. And we can get into this a little bit later, but what we did is we created a structure so that we could efficiently move money in and out of Canada without getting hit by the Canadian tax authority. So that's one side of the tax efficiency. The other aspect in the Canadian markets that I think really grabbed my attention, and probably I think would grab most people's attention, is the fact that the Canadian government, the Canadian regulators are actually much more lender friendly than the U.S. regulators.
Yeah, this blew my mind.
It's crazy. I mean,
for Canada being much, generally more progressive.
100%. And this is where I also scratched my head for a little bit, but I called, some other Canadian lawyer friends that I knew, and I said, hey, is this true? And it is. And so what's really interesting is the Canadian provinces fall into 2 different regulatory regimes. So there is foreclosure, which is much like the U.S., in that you have to go through a formal foreclosure process, actually take over ownership of title. And then once you have that, you can, liquidate the asset. And then there's a power of sale process. So Ontario, just to give you an example of like 2 big provinces. So Ontario, Toronto, the most populated province, is a power of sale province. British Columbia, Vancouver is a foreclosure province. In the power of sale provinces, what happens is there's a truncated foreclosure process where you actually don't need to take and physically own title before you can actually list the house for sale. So again, assuming everything's moving swimmingly and, we are a little beholden to the court system on this, 15 days after a single missed payment, you can note somebody in default. You then also simultaneously notify them that we're initiating power of sale proceedings. They have to be served as certified mail with that document. But 35 days after that is when we can submit for a writ against them, or a summary judgment of them in default. Once we have the summary judgment of them in default, we have to serve them with that. After they've been served with that, if they still haven't done anything to get into good standings with us, we can then submit to the court for a writ of possession, at which point the summary judgment actually issues an eviction date. If they don't voluntarily leave, then you get a writ of possession, and the sheriff shows up and escorts them kindly off their property. So soup to nuts, assuming everything's going swimmingly, you're kind of looking at like a 60 to 90 day recourse for non-performing loans, which I think is a key factor in describing the fact that delinquencies in Canada, and we got to remember here, delinquencies in the United States are usually measured as 90 days DPD. We measure it as 15 days DPD, but on an apples to apples.
What does DBT stand for?
Sorry, days past due. But on an apples to apples basis, there's good data on this, but delinquency rates in Canada are about 1/8 of what they are in the United States. And again, a lot of that we attribute to this, from our perspective, or U.S. perspective, fairly punitive process.
And 2 things I want to highlight here, because Hugh, got technical, kind of show how friendly it is. No, that's fine. I just, it took me a few iterations to understand, to wrap my head around it. 2 points I want to highlight, kind of keep it at the 30,000 foot view for everyone, is like, fundamentally understand the Canadian residential market. They don't have 30-year fixed mortgages like we do in the U.S.
Yeah, that's a good point.
Hey, right, I've got a 2.5% interest on my primary. I got 27 years left on my mortgage.
Yeah.
In Canada, it's typically a 3 to 5 year ARM.
Yeah. Or ARM equivalent.
Yeah, where they'll have it locked in for 3, 4, 5 years. A lot of times from the big banks up there, but after that term is up, they have to go out there and get a new loan.
Yeah.
And that's where a lot of times creates the opportunity here.
Yeah. So there's two fun points there. And again, I'll try not to get too technical, as I like to spend some days and time in the weeds and things. But yeah, so the US is the only country in the world with a 30-year fixed.
Yeah.
Right. Which is a very, kind of confounding and interesting thing. And you'd be surprised how many like very sophisticated investors that we talk to say, really? Canada is your standard, the major banks, it's kind of akin to a 5-year arm in that, in the US 5-year arm, it's locked 5 years, then it floats. In Canada, it's instead of floating, it goes to a forced refi mechanism. So every 5 years, we know that if we have a loan in Canada that we, 5 years out, our rate is not going to be the same. It's kind of hard for us to fathom here in the United States, given the 30-year product. It also is, again, I think creates a little bit more stability in the asset class, because if you're modeling out 30 years versus 5 years, I think both, have their flaws, but, shorter is always better when you're modeling out. And then the other really interesting thing I point about this, and because I don't know if we've talked about this much, I think we maybe a little bit, but what the Canadian banks have to do when they're underwriting a mortgage is, if prime right now in Canada is, I think, 4.6 and change. Obviously, just like the US, very few people actually get prime. So let's say the average is 200 basis points above that, so 6.6. But what the banks actually have to do is they have to underwrite to 200 basis points above whatever the rate is that they're giving, which is a really interesting phenomenon, because there's all these rules, right? And we mentioned earlier the regulation that kind of create this market. So in a second position, like oftentimes that's what we're doing, is we're filling the balance that couldn't be, that the banks would have wanted to underwrite to and would have loved to lend at. And especially in the United States, they would have. But in Canada, the banks can't. But the other really interesting thing, point about that, I think, is that we've heard a lot of noise in the news recently about Canadian asset bubbles and what's going on there and blah, blah, blah. But if you look at where interest rates are today versus where interest rates were at the peak in 2022 of the housing market, we're almost exactly 200 basis points above. So from a bank underwriting perspective, these individuals should be able to carry that debt, even that, obviously it'll be painful and what have you. But so there's certain things that maybe are overblown. Now, obviously there's other aspects that impact that, economic aspects, but we don't need to dive into that, because that's maybe a little bit boring for everybody on the call. But again, it's an interesting dynamic that exists in Canada that you don't have existing here in the United States. So this, then, I think we're talking about. So we've talked about the standard products. Now let's talk about the private markets, right? And I think it's always good to make the comparison between the U.S. and Canada, because U.S. is what we know, Canada is what we're learning about. In the US, private markets, now there are exceptions to the rule, but if you look at large players in the space, like an Invictus Capital Partner based out of DC, or some of these other large hedge funds that used to play in the space or do play in the space, that this is all they do, is kind of similar lending to us. They are issuing in the private markets 3 to 5 year arms, right? That's their standard product. It's generally for people that have adverse credit history or small business owners. The backdrop is 3 to 5 year arms versus a traditional 30, right? Our traditional is 5 years. So we're only issuing 12-month term loans, right? In both situations, most of the times these are interest only. So they're not as punitive, and regardless, even on the 5-year traditional product in Canada, there is an amortization schedule that's 20 to 30 years. So you're not, it's not like 5 years you have to pay off $1 million and 4, 6, 7% interest. But that shorter duration was another kind of really interesting aspect to me, Because what we can do and what we've done is in our fund is we've designed a product, as Chris showed, a 15-month lockup. So 15 months, that's the equivalent duration to a 125. If you go and Google, Fidelity short-term bond fund, we're about the equivalent of a short-term bond fund, but our return profile is that of a private credit fund. So in designing this, what we've tried to do is kind of thread a needle, if you will, and provide best of both worlds in that, if you look at a lot of private credit funds, lower middle market, even real estate, you have liquidity profiles of like 3, 5, and 7 years, which, if they work, that's fine, but that's a long time to have your money potentially tied up. Let's see. So going on. So let's talk about the tax structure on two ends. So first, we mentioned earlier how our kind of first foray or our first lift that we needed to do was to make sure that there would be no adverse tax issues for U.S. investors. And I think we can talk a little bit about how the Canadians play the market, right? Because then it'll give a sense of what we were trying to solve for and what we did solve for. So if you guys are sitting there and saying, "Hey, this is starting to make a lot of sense. This is great. What do we need? Like, let's go find somebody in Canada that does this." You can find people, and there are definitely institutional players that do this. They're usually done through what's called a mortgage investment company or corporation, MIC for short, or MIC. And if you were to just do that, then you would actually get hit with a withholding tax on the Canadian side. And then there would be a foreign tax credit, right? So everybody hates taxes, number one. Everybody hates complicated taxes, number two.
Yep.
So when we were first diving into this, our first step was, okay, we got to solve this. Because if we can't solve this, it becomes a much heavier lift. And so we've done that. And this is where if you look at Aman is partner, but not partner, right? He is linked to us at the hip, but he works through a separate entity. And again, not to bore everybody with the tax details, but what happens then is we're connected through a contract. That contract creates parity. But the mind and the matter of the work is done here in the United States. And because the mind and the matter of the work is done in the United States, then the CRA, the Canadian Revenue Authority, says you're not doing business in Canada. Therefore, you do not need to pay Canadian tax. So that was the first approach that we wanted to solve for. The next thing was kind of like on our focus. What part of the market do we want to attack? And so we mentioned before, there are a lot of MICs that exist, and there are some institutional MICs, $700 $1 billion of AUM. But as you get up to that scale, especially if you were built not on a tech-enabled platform, as most of them weren't, because they're old and been at it a long time, they have to chase the bigger deals just to deploy capital. There are, by sheer numbers, a massive amount of MICs that exist where they're just like investor clubs. So 20 people get together, they form a MIC, everybody kicks in $100,000, and they're kind of like casually investing these assets. And then additionally, and that's the tax advantage way to do it for Canadian citizens. Additionally, you have people that are just saying, two people or one person that can do a private credit deal, because anybody can be a private lender, and private lenders are unregulated. So what we quickly identified is the lower end of the market that is always going to be more efficient. Doesn't matter what you're in, whether you're in equities or venture capital or private equity, right? The lower end of the market is always going to be the most inefficient, meaning that we can get the highest potential yield returns. So let's focus on that. And if we bring an institutional process to that space, then we're competing against these quote unquote investor clubs. And everybody is sourcing deals the same way. It's through broker networks. Brokers are highly incentivized because brokers in Canada make more than brokers in the United States on a per deal basis.
The fee load that the Canadian borrowers have up there,
it's terrible.
Yes, it's much higher than I was expecting, and much higher than we have here in the U.S.
100%. And so, the brokers, right? Their incentive is just to get deals done, and the thesis, and it's playing out, is we'll stay in the smaller end of the space where it's less competitive, more inefficiencies. We will bring an efficient process, and therefore we can take market share from our competitors, which are these investor clubs, not these like massive, like the BlackRocks of Canada, right? And then as we scale, we build the efficiencies and the tech to help support that growth initiative and that focus. Additionally, you also have this function of that just from the get-go that there is this supply demand imbalance, right? So like our showing up to Canada is not the equivalent to us, potentially showing up to Dynamo's market and then trying to compete against Dynamo and trying to steal market share from them. It's literally like we show up and the brokers are giving us unsolicited $10 to $20 million in deal flow a month, just because we have capital and because we have potential capital. So that's a little bit there. Just sticking on the slide, just because it's mentioned here, we would talk about the hedging strategy and then the leverage strategy. I think we go into some.
We got those in detail later.
Okay. Yeah. So we covered, kind of foreign tax withholding, which we're solving for. So in the Canadian market, right, just like the US market, there's first and second liens. In the private markets, there's first and second liens. What we're seeing today, kind of on first, well, I'll tell you, like our last first we did was on December 23rd. That was a fix and flip deal. And that was at an effective 12.64 to the fund with a 12-month prepayment. We think that will end up kind of more in the 17% box, because the other fun thing is that in Canada, or at least for our loans, we get 3 months of prepayment interest. So these fix and flippers are great opportunities for us because oftentimes they're interest rate agnostic. Additionally, they are, their hold time is 4 to 6, maybe 4 to 8 months, which means we will collect our full 4 to 8 months plus a 3-month prepayment fee. So, we're kind of seeing between a 10.99 and call it 12.99 on firsts. Seconds, we're seeing 13.99 to call it 16.99. And obviously there's a dependent factor, underwriting factors that go into that, credit score, equity, location. Basically we want to make sure that the juice is worth the squeeze there. Our average loan size in the book currently is about $400,000. We expect that to probably creep up a little bit as we continue to grow. And we can talk about why and a focus on first as leverage gets implemented too. But and then the areas of focus for us currently are Ontario. Obviously, we mentioned that earlier because of the power of sale, and also it's the most populated province. We've also identified New Brunswick as a very attractive place for us to be, and the reason is twofold, right? Well, it's actually not necessarily twofold. It's all encompassing. So there's been a big move to the Atlantic provinces, because one, it's less congested, it's beautiful, so quality of life is quite high. Canada has been a little less forceful in pushing back and in-office work than the US, so the ability to work remote is much higher in Canada. But then on top of that, the cost of living, right? So the average, depending on what source you look at, the average home price in Ontario is anywhere between $890,000 to $1 million. In New Brunswick, it's about $350,000.
So affordability.
So there's a massive affordability push, and especially On the immigrant side, there's definitely a lot more blue collar jobs, right? There's a lot of fishing industry around there, so there are jobs that need to be filled. So if you have population growth and relatively low asset prices to other areas, that's a good demographic to be focusing on.
What's the LTV or combined LTV that you will lend on in your credit box?
Yeah, so we have a pretty hard and fast rule that we won't go above 80%, regardless of whether we're in first and second position. So first position, it's $1 million home, 800,000, right? Second position, it's $1 million home, and they have a first at, let's say, 600,000. Max we'll go is 200,000 additional dollars. So keeping that buffer in place. We do have the ability to go up to an 85% LTV for like very high credit scores. We have yet to do that. In fact, we've gone the opposite direction. The portfolio is currently sitting at like a 76.4% weighted average LTV.
So about 76% altogether?
The weighted average of the book is 76%.
One thing I want to highlight here, because this was, this is I think a new concept for many of us investors here. Like, a lot of us invest in debt funds in the U.S., and every single debt fund and hard money lender I've ever seen, it is for non-owner occupied investment properties. The bridge, the fix and flip, the ground up construction, right? They are investor loans, where a lot of the loans that Leeward is doing and the Canadian private market is doing is to owner occupants. And that was, I think, it's a very important thing to highlight, because that was a mental shift for me among quite a few things with looking at the Canadian market. Is a lot of these are owner occupants. Do you know what percent off the top of your head is like owner occupant versus? I know we're doing the loan tape walkthrough in like 4 weeks.
Yeah.
So we'll do more on that. But like, this is just an important thing I want to highlight, because we all know the difference between investor loan versus, hey, this is my home. You care a lot more about your home than the rental property you own.
Yeah, so I'd say, again, not having it right in front of me, I'd say on a sheer numbers basis, it's probably like 2/3 to 3/4 of ours are owner occupied. On a like weighted average, it's I would venture that it's probably around the same.
Okay. That's good enough. And again, asterisks, they were actually doing a loan tape walk in a few weeks, but just wanted to really, really highlight that point.
Yeah, no, I think it's obviously is a good point. And I think it also, right, like there's added stability with that, right? And part of our underwriting process and our diligence is we can actually look and see, how when they purchase the house, how much they're into it for, so we can also understand, all these dynamics around, like what's the probability of them letting this go.
Yeah. So talk about briefly, Hugh, just kind of like, I'll say the institutional mindset that you and your team bring. For me as a real estate investor, I've always been on the other side of institutions, and I think that's for a lot of investors on the call, right? And just, I've learned, first, my vocabulary has expanded a lot from talking with you and your team, but also just like the way you problem solve, or you look at structuring, or the processes you implement, I'll say is very different from, a lot of deals I've looked at, and just kind of like investor mindset in general. So talk about that approach.
Yeah. So maybe ask the question differently, or is there an example that?
Well, just like, because you guys come from an institutional background.
Yeah.
And so talk about how, when you go out there and lay out like your operating procedures, and you look at things like, how is that institutional background focused what you've done at Leeward?
Well, yeah, I think it drives everything that we do, right? Because at the end of the day, both within our management company and within the fund, we're trying to drive costs down as much as possible, efficiencies up, whether on leverage or who our service providers are. But I think what maybe differentiates us from this market in particular and others is that we set out, and I think Chris and Rich have seen very clear guidelines on like what we're looking for specifically. And then that, like we just stick to that. So like we can funnel through a lot of deals, even without like tech enabled, and get to a quick yes, no commitment letter to get money to work, but also to get money to work in the right deals.
Yep.
I think is
Yeah. Your answer.
So let's see. I want to make sure that there's enough time for Q&A, as I'm sure there's probably some questions. But let's
move on to the hedging, because
Yeah.
actually perfect. I see a few questions in here. People like, hey, different currencies.
Yeah.
What happens as USD and CAD? They do their thing.
Yeah. So for the purposes of this, I'll lay it out, hopefully fairly simply. I can get pretty technical on this. So if I put you to sleep, I'm sorry, or you're welcome. But effectively, the way that hedging works is we use what's called a forwards contract, and a forwards contract locks in the FX. So if we are to, let's say, I think earlier today, the USD CAD spot rate, so the rate at which the exchange occurs, was like 1.35. So let's say we put some money to work. We then enter into a forward where we lock that rate, 1.35, which means that when we need to pull money out, you're not losing money on your principal. So it's a fairly ubiquitous and easy strategy to deploy. We're not trading in currencies. Like, we don't have a global, or a crystal ball that says where the FX rate is going to be 3 days from now, let alone 3 years from now. And that's really what we want to solve for, right? Like, what we can't control is when our investors need all or some of their money back. What we can control through capital markets and the financial tools that are available to us is making sure that we can protect that principal as best we can. And for a fairly de minimis cost. I think, entering into a hedging contract, a forwards contract, is anywhere from like 8 to 15 basis points. So that to us is a very worthwhile expense.
Yeah. And the whole goal here is, again, to just, mitigate, any loss of return just from like the way the currencies can fluctuate.
100%.
And I think we'll kind of like leave it at that. The whole point of this webinar is kind of give everyone the 30,000 foot overview. And then in a few slides, we've got a lot of detailed continuing education to kind of do deeper dives in here. And we'll get into a much deeper discussion on the hedging strategy. Understand it's in place there to help protect downside risk.
Sure. Yeah. And then I think the other one that we need to cover, and because it was in the agenda, right, is the leverage. So I think, leverage in this asset class, whether it's in the US or Canada or, Singapore, and just real estate in general, right? Everybody's fairly familiar with it. It's fairly common. We are days away from getting a term sheet from a very large institutional group out in New York. Won't tell you who it is until we get it, but the underwriter on it used to do all the underwriting for Bear Stearns. He was the head of CRE for Bear Stearns and JP Morgan. So we're pretty excited to have him in our corner. But yeah, I mean, the way to think about leverage, right? So, and what I mentioned before about maybe focusing a little bit more on first is at the terms that we're expecting, right? And this is, when we model, we always model to the kind of like the worst case. Our first at, the 12 points, call it a 12% return, top line gross yield, should go to 20, right? And I think the other aspect that we haven't quite touched on, and I'll do this quickly now, and then because it kind of is intertwines, is the other structure that we're implementing is we've created and I mentioned right in the beginning of this, my career is in structuring. So I've done this before. I've done this in Ireland, and this time we're doing this in Luxembourg. But we're creating a securitization vehicle which has a myriad of benefits. But again, at a very high level, what it does is it opens us up to international markets and spreads. Debt is much cheaper outside the U.S. right now. It also allows for us to do deals directly with like large institutional money outside of the US. But the ancillary benefit, and we're not doing this for this, but what we get for US investors is that tax treatment that Chris mentioned early on, where you get the qualified dividend treatment. So what's important about that is if you look at, going from a 12% unlevered yield to a 20% levered yield, and analyzing that in relation to other debt managers that maybe don't have this structure in place where you're paying interest income. And again, worst case scenario, let's take the top end of the federal tax bracket. At 12% return, you would need your other manager. So this would be net of fees, but before tax, right? The other manager would have to post a 17% equivalent to get the net effect, right? At 20%, they would have to post a 26% return to get the net effect.
So it's 5 or 6 or 7 percentage points higher.
Yeah.
There's a lot of times, 25, 30% higher.
Correct.
Altogether.
Exactly.
And this is where, again, talk to your CPA.
Right.
But just kind of talking about, because everyone says, hey, Property Llama, we want cash flow. The second thing is, hey, we want tax advantage stuff.
Yeah, of course,
and
everybody.
Yeah, debt funds don't mix with depreciation.
Yep.
But then this is one of the things that we really found attractive about what you structured at Leeward was that you came up with a very, very tax efficient way to do it, which is different than like a sub-REIT that a lot of debt funds use out there.
Right.
You do this way to greatly reduce the tax burden.
Yeah, and we've have a tax. So again, I don't know if this matters or not, but our lawyers on this are A&O Shearman. A&O Shearman is like the second largest law firm in the world. And their tax opinion in layman's terms is the distributions from the securitization vehicle back to will have zero income implications. So it won't be classified as income.
So what will be classified as then? Dividends.
Yeah.
Okay. And that's what gives us the favorable tax treatment.
Correct. Because so again, we could probably spend hours on this. But high level, right? Funds are effectively pass-through vehicles.
Yes.
Right. Ours is no different. So if the asset that you're owning is classified as dividend by the IRS, then it'll be classified as dividend on the K-1.
Great.
Let's see. Yeah, I think those are the prepared remarks.
Yeah, so we got a few more things, but just wanted to, and we'll make this slide deck available to everyone. Like I said, this was like the 30,000 foot view overview. But just, from a high level, wanted to share some of like the terms that, Leeward has. And I mean, with your guys' institutional background, you've gotten some institutional checks.
Yep.
And your minimum's, $1 million.
Correct.
And that's part of the reason where Property Llama comes into play is, hey, we can pull our capital together to provide access. And also then the more we get, we get better terms as well.
Correct.
I just wanted to share, if you want to walk us through when the fund was started and just, who your like third party vendors are as well.
Sure.
Because I think it adds a lot of, third party credibility.
Yeah. So we launched in November of 24. We launched with the family office out of New Hampshire. It's a group that I've known for forever. And like they say, it's better be lucky than good. They were looking for emerging managers. They like real estate. They love credit. We kind of checked all the boxes, and we were a known entity to them. And they've been phenomenal partners with us. And we have a board. They sit on our board. But a great group to have in our corner. So the target fundraise, right, is 500 million. And we kind of maybe give you a sense how we got to that number. In Ontario alone in 2024, because we don't have the 25 numbers yet, this was a $32 billion asset class. So there are $32 billion of private loans originated in 2024. $500 million is, a fraction of that.
Mm-hmm.
So we figured, everybody gets super excited, especially in like venture private equity, when you talk about TAM and you see these massive numbers, but it's not actually like the TAM that matters. It's what
is TAM?
Total addressable market. So it's not the TAM that matters. It's what can you realistically capture of that, right? And so by, again, being conservative. So $500 million, open-ended 15-month liquidity window we talked about. like Chris mentioned, $1 million minimum. And then, getting into our service providers. So, Baker Tilly is our fund admin, our tax and audit. So, every year we do tax, and then they do a full audit of the actual fund. That's as part of the way to get your K1s. But, Baker Tilly is a massive player in the space, as just a tax and audit partner. We were with Moss Adams, and they got bought by Baker Tilly, which is great because we were paying Moss Adams prices and we got grandfathered in. So now we get Moss Adams prices, but with the Baker Tilly name. So that's great. NAV Consulting, I think you all should know, because
that's who we use a lot of our funds.
That's who they use,
and they're one of the big boys in the.
Yeah, and I think I've worked with a lot of fund admins. There's the groups like SS&C and Apex and Maples that get thrown around a lot, and that's who, your massive groups use. But, it's really about when you're picking a fund admin, it's about the service that you're getting out of them. And if you're a small player in a big shop, right, you're getting the C-level team.
Mm-hmm.
That's not to say that NAV is small. I mean, I think they're like 500 billion now in AUA. They're growing. But the service that we've gotten out of them has been better than like the service that I've gotten from an Apex or a Maples or an SSC at previous shops. We then custody all our assets. So what happens is when subscriptions hit our account, they go to a trust account at UMB. So all these transactions get logged. And then it also, what UMB does is they'll log our, they spot price the FX on a daily basis. So we know fluctuations that occur. They handle conversions to CAD and then our wires out. And quickly, like the flow of funds for us is, and this is where the fees come in that Chris talked about earlier, but we send out a commitment letter, everything, all the contingencies line up. So we then wire capital to our lawyer wires capital to their lawyer, their lawyer wires capital to them. So there's a lot of steps in the process. But then just quickly to finish up so we make sure we have time. Stout is a valuation agent. So every quarter we get a third party mark on the portfolio just to validate that, it is what it is. So unbiased third party assessment of our valuation. And then in Canada, our legal for structuring has been Thompson Hines and Faskin. We're actually in the process of I think upgrading both of those. The docs were done by those groups and they're very good. But we're moving to either A&O, Sherman for the U.S. They obviously have done our international work on this, or Patton Boggs, which is another big firm, not as big as A&O. And then in Canada, we're going to move to Bennett Jones, and mainly because I have a relationship with a principal there, and they're willing to do a lot more work for us without charging us. But they're also a bigger firm than Faskin, so. So that's just a kind of a sense, like we don't want to let things go. We err on the side of cautiousness, right? That's our mantra, if anything, I think.
Yeah, and that's kind of the whole purpose of investing on the debt side, right?
100%.
Less likely to lose money on the debt side. Got a couple slides, and then we will go through the questions here. Just want to wrap up with the how to invest and just really next steps on learning. Again, our goal is to bring you great opportunities, great operators like Leeward, but then just give you all the information, be transparent with everything that we know. So you make the decision if you want to invest or not. Again, going with the summary here, one thing I want to make sure I point out, since I forgot to do it on the first executive summary, is I quoted, hey, the target returns this year about 12.6 to 15.4% is what it's shooting for. That's assuming once the line of credit or leverage is in play, and we'll have the final details on that next couple of weeks. And if the lock is not in place for whatever reason, then the returns will fall below that, and we'll share those numbers as we get it. But you guys are finalizing the terms, and we will share over the next couple of weeks.
Yeah, I mean, I think the way to think about that is like it's a when, not if. scenario. So the line of credit will happen. It's just a function of making sure that this is the right line of credit.
Yep.
Right?
And like I said, so we are shooting for that 12.6 to 15.4% this year. And then we have that special offer, since this is a new fund, that for any investments made before April 30th, you get that share class bump. And so we'll go into more details on this, later on as we get in the details of the fund. But that can usually be anywhere from about a 6 to 7% increase in your return. All right, so next steps on here. We have a lot of events coming up for our Leeward due diligence series. And it's great that Hugh lives in Wash Park, and the U.S. team, they're Denver-based as well.
100%.
And then we've got Aman, who's in the Toronto partner in Canada. So we will share these dates, but next week on February 19th, we've got Leeward Q&A 1. We'll just do a Google Meet for Q&A to get all the questions people have.
Yep.
We'll put Hugh and any of the team members in the hot seat. 2 weeks from now, we have a Leeward loan tape walkthrough. And this is, we will just pull up the loan tape. They will walk us through a handful of loans, how they look at things, how things are performing, just a very transparent view as to what they looked at. And this is where we spend a lot of time in Toronto, just going through item by item, document by document, just to all right, let's make sure everything's there and verify all the account transactions. March 4th, we will have our second round of Q&A with Hugh and the Leeward team. And we got a couple tentative dates. Around March 10th, we're planning an in-person event. And then March 17th, we're going to kick off our monthly investor updates, where every single month we'll just come and give, a 30-minute or so update as to the performance, how things are going, how Leeward is scaling, the returns, just so current investors are up to date. And of course, for prospective investors, it's always nice to say, hey, what'd you guys do last month? Let me see what's going well. What speed bump did you hit? So we have all these events. We'll send out emails. Feel free to schedule a call with us. Or if you guys want to talk to Hugh as well, let us know. He's available for calls or for coffee if everyone's pretty close. But we'll do a lot of this group stuff in the beginning and then, filter down to some one-on-one stuff with Hugh. If you have interest, we do have our soft commit form here, which again, this does not lock you in. It just kind of gets your line in place, gets you queued up for the docs, and then gets you ready to go so you can invest and sign by April 30th. With that said, we will move to Q&A.
Yeah.
And I have to, unfortunately, get closer to the computer here to read these. So give me a second. All right. First question, rapid fire, Hugh.
Yeah.
Do you have a fund option for a 1099 INT or interest for a Roth account?
So we can take qualified assets up to a 25% threshold.
Okay. So if you have a self-directed IRA or self-directed 401k, they can take the money.
Yep.
But no matter what, you're going to be issuing a K1, correct?
Correct.
Yeah. So everything you get will be a K1. And if you do want to invest through your retirement account, you got to go out there and make sure you have a self-directed retirement account.
Correct.
If you guys need any recommendations on there, we've got a lot of great custodians that can educate you and get you set up. Is there a UBIT blocker for self-directed? But since this is dividend.
Yeah. So currently in qualified assets under a current structure, with leverage would hit UBIT, right? Without leverage, you do not hit UBIT. When the Lux structure should be in place by the end of this month. And when that's in place, then no, there should not be any UBIT consideration.
So as you're getting the final stuff in place, you should have an equivalent of a UBIT blocker in there.
Correct.
Yeah. Target size of the fund is 500 million. What is your current AUM?
Yeah, good question. So we are, we are about $5.5 million today, a year in. So kind of first year is proof of concept. We're looking to bring in another $2 to $3 million in this month. And then we have, a pretty full pipeline. 500 million, I'd say, is the target on the upside, right? Like we want to grow this thing, but more important than like the top line number is like, are we doing this judiciously, right? Because unlike other private credit funds, because these are 12-month assets, if we take in $1, we know 12 months from now we potentially have to find a new deal to deploy that dollar. If we take in $2, then it's the same thing. So scalability, we want to just be very, very cautious of, and make sure that we're building the efficiencies to do it.
Are you concerned with the Canadian housing market crashing?
Yeah, this is one we get a lot. We kind of alluded to this a little bit earlier with the noise around the Canadian housing market. So my crystal ball doesn't show me is, how long tariffs are going to be in place. If the Canadian government has the ability to offset lost revenue through bilateral agreements with other countries, those are the unknowns. My gut is telling me that, the pain that's being experienced in Canada is being experienced here in the United States too, because they're our largest trading partner as well. And additionally, what is it? The end of last year, there was a report that was put out that said U.S. Canadian trade on both ends was the lowest it's been in like multiple decades. However, Canada has increased trade with other partners by 15%. So they've been offsetting that. So again, that's an unknown, right? And has a could potentially have long-term effects on the housing markets, right? Because of macro kind of like unemployment rates and the like. What I can say is that if you look at the data, right, housing prices peaked in first quarter of 2022 in Canada.
Just like they did here in the U.S.
Just like they did here in the U.S. The difference is that Canada in 0809, Canada did not see a sell-off. It was like maybe 3 to 5% was the sell-off, as opposed to our like 35 to 40%. So the run-up that they experienced was much more drastic than what we experienced in the United States, because they started at a higher base, right? We have seen about a 35% sell-off since that high. So could there be more pain? Yes, that's absolutely, available to us or in the cards. But with interest rates where they are, so interest rates are below their long-term average. Unemployment rates for 25 plus is basis points below. So let's say at its long-term average, and asset prices are 35% off their highs. That should set us up nicely for a, at least stabilization, if not a rebound. Now, again, it could go further, right? We could see another couple percentage of sell-off in asset prices. But again, that's where we love the short duration of our exposure, because we get to reassess on an annual basis.
Great. Last question here, and then we will wrap up. What is Aman's background and track record in Canada for originating, and what has he done with private loans before?
Yeah, so great question. In conjunction with being, a real estate and then eventually a trust and estate lawyer, he actually ran a MIC in Canada from 2017 to 2023. And so he has been in the weeds and been doing this. And then prior to that, he actually had a relationship with one of the largest mortgage brokerage franchisors in the country, where their franchisees could utilize his services at a reduced rate. So he's been on both sides of transactions for almost his entire career, and as well as actually run a MIC. And
the MIC is the investor club.
Yes,
right?
Correct. The mortgage investment company.
And if I recall, he did around 500 loans to that vehicle.
About 500 loans through that vehicle. He did other loans through syndication, so about another 100 loans through syndication or so. And had, zero impairment of principal through that track record.
Awesome. Well, we are a minute past, but I think we got all the questions in the chat. I know more will be coming. Let me, Christy, Matt, Richard on the Property Llama team know. We will do our best to answer, but most likely we will collect them. We'll start batch them for our Q&A next week. And then we'll just start methodically going through all the questions and helping people understand the Canadian market.
Yep.
Because that is just a big, learning curve there, and you have to wrap your head around that as we get into the fund specifics. But Hugh, big thank you for coming down to the studio today and presenting. This is awesome. So thank you. Okay. Everyone out there listening and watching, a big thank you for giving us, an hour and change out of your day. We appreciate you giving us your time. We look forward to talking to you, and we'll see everyone very soon. Bye-bye.
Yeah. Thanks, everybody.